Divergence trading is one of my most common strategies and most profitable. So by the end of this video, I want to be able to show you how to spot them and how to trade them. If you don't know who I am, my name is EQ. I've helped over 1,000 people learn how to trade within the last 3 years. So without further ado, let's roll the intro and then get this video started. But before we look at it on a chart, let's look at it here real quick and go over some of the key points. So what a divergence does is it really helps you spot trends that are potentially going to be reversing or continuing well before they actually happen. This is considered a proactive trading strategy in comparison to what you would get by using EMAs, HMAs, SMAs, those types of things, which are going to be more of a reactive strategy. Now, there are bullish and bearish divergences, and then there are two different types or more common versions, the regular and the hidden. Now, a regular divergence is going to be a trend reversal. So normally you would see those at tops or bottoms, at swing highs or swing lows, and it would be the first sign that a trend could start to potentially distribute and then move in the other direction, or accumulate and then move in the other direction, depending on if it's either on the top or the bottom of the move. And vice versa, a hidden divergence is going to show you continuation potential. So these are more than likely going to be found on, let's say, a Fibonacci retracement or some other area where there is a high probability for a continuation. Now, where I like to stack this with candlestick patterns is that if you're looking for a continuation pattern like a cup and handle, and you see a bullish hidden divergence showing up, that could be a really good sign. And vice versa, if you're looking to trade, let's say, a double top and price just created a higher high, but you notice there's a regular bearish divergence and there's lower highs on the oscillators, then that could be the first sign of a potential flip in trend and a potential short, or an area that you'd be taking profit depending on if you were looking to get in a trade or looking to exit a trade. Now, if you did want to learn how to trade, I would highly suggest going to EPIQTradingFloor.com, EPIQ. Go and grab a 3-day free trial. If you want to learn more, click that. There's a 3-minute video that you can watch that walks through everything you get. And then I would highly suggest starting right at the courses, go into the Trading Academy, and start to dive into that information. Especially if you're using the free trial, you're going to be able to get free learning. And this will walk you through everything that you would need, from learning bullish and bearish, what a candlestick is, how to read candlesticks, all the way to support, resistance, trends, divergences, sniper entries and exits, you name it. So I'll have this tagged in the video as well as in the description for anyone that is interested in joining the EPIQ Trading Floor. Now, the first one we're going to look for is a regular bearish divergence. So right off the bat, the first one that I can see that's a great example is going to be this high and this high. So when I put my trend line, you can see that we did create higher highs, but when I zoom in to the MACD, you can see that we created lower highs on the oscillator. And same thing with volume. When you look at volume, this also created lower highs. This would be a strong sign to me of a regular bearish divergence, and this would be the first sign that this up here would potentially be the first area for a trend to start to flip and go into a reversal. And as you can see, it started to play into that and sold off about 7% from that regular bearish divergence. And this isn't fully confirmed at the moment, so this is just a potential, but there is a potential right now for a regular bullish divergence. So as you can see, there are lower lows in terms of price action, but at the same time, if you go look at the MACD, you're creating higher lows right now on the oscillators, and same with the CCI. If you zoom in on this, you can see higher lows. These would be a first signs that potentially this trend, this downtrend, could be ending and we could be swinging back to the top side. Now, the other side of this are going to be the hidden divergences. So the first one we're going to look at is a regular bearish divergence. Right off the bat, you can see right here you had a nice high, and then you had this swing high, which is creating a lower high. So lower high. Now when you go look at the CCI specifically, you can see that we created a higher high, which would mean that this area is already more overbought than what we saw over here, saying that this was already more overbought than this price point. So that would be the first sign of a continuation. And then from what we saw, we had a sell-off, push up, hit into this continuation, sold back off. Now, if you remember what I was talking about stacking confluences, if you did a downtrending Fibonacci from this point, you can see that we did land just at the 6180 into the epic golden pocket, which is an ideal zone for a playthrough. So when you did see this hidden bearish divergence pop up, especially in this type of zone on the Fibonacci, there's strong potential for this to continue and play back down. And now the last one that we'll be able to look at is going to be the hidden bullish divergence. So if I go from this swing low over here, down low, you can see swing low down here, and put it to this next swing low over here, you can see that we've created higher lows in price action. But if you go to the CCI or you go to the MACD from those times, you'll see that from both spots, we're hitting lower lows in terms of the oscillator. So what this is telling us is that we are well more oversold at this exact moment than we previously were over here. And this could be the first sign of this trend wanting to continue. Now, get a Fibonacci, go to the bottom of the trend, go bottom to top, drag it up to the top, and you'll notice price was landing just within the 6180 and the 7860, which I was just mentioning. If you see continuation patterns start to land somewhere within this zone, there's a really high probability and potential that this could theoretically play out into whatever divergence it is. So because we are in a retracement, we're looking for a continuation pattern because it's a Fibonacci. And so we're getting both of them. We're getting that hidden bullish divergence, so price potentially wanting to swing back up. And at the same time, when we zoomed in, we had the lower highs, so we have that regular bullish divergence. So something to keep in mind is that when you're looking at this from a long-term perspective, when you're looking specifically for a hidden divergence, keep in mind that it's very, very common to see a regular divergence within the hidden divergence because the trend is going to be retracing. And so in a continuation pattern, at some point, this is going to have to end the trend and distribute so it can go back into the original direction. So while it's ending that trend, you can see the opposite. So as we're setting up for this hidden bullish divergence, there's a regular bullish divergence that shows up here. So both of these are saying that, okay, this trend is more than likely or has a very high probability of starting to drag out and play back up. And then it's also playing into this long-term divergence. So these are going to be divergences in a nutshell. If you have any questions, please don't hesitate to ask, drop a comment, join us in the EPIQ Trading Floor, take advantage of that 3-day risk-free trial, and you can always send me a DM there. If you did learn anything in these last 10 minutes and you're not following me or subscribed, make sure to hit that subscribe button. It'd be greatly appreciated. I hope you have an amazing morning, afternoon, or evening, depending on wherever you tune in the world, and I'll see you in the next video.